What a great day in the stock market. Of course, we started off late yesterday with news that President Trump was going to meet with North Korea's leader. And then we rolled into this morning when we had an excellent jobs report, or at least what we found is that the market reacted very positively to that jobs report. So we did find the Nasdaq hitting all-time highs today. So that was the first time in a couple of months. And of course, today marks an anniversary of sorts. Remember what you were doing 9 years ago on March 9th as the stock market was bottoming, and how far we've come and what we've learned along the way. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It is March 9th, 2018. All right, so let's go ahead and remind you that when you are on YouTube, there's a really quick way to access David and I's videos, and that's to subscribe to our video channel. So if you see a red button there, make sure you've already clicked that. In addition to that, we would encourage you to click the thumbs up if you appreciate these daily free videos that we're willing to put together for you. If you have comments for us, go ahead and scroll down to the bottom and leave those comments. And then lastly, in the description area, we do have a place where you can sign up for our email distribution list, which would entitle you to receive the list of the stocks that are giving you overbought and oversold clusters within the S&P 500 each day. Now, in addition to YouTube, we're also both heavy users of Twitter. You can follow me at Brandon Van Zee, all one word. You can follow Market Scholars at Market_Scholars. While you're on Twitter, we would highly encourage you to like and retweet these Market Outlook tweets if you do find value in them. I've noticed that the likes have gone down a little bit this week, which is kind of interesting considering we've been engaging with you a lot more this week. So let's not forget to do that. If our likes are up and over 100 on a daily basis, I'm not going to question it. If it's less than 100, then I have to question whether it's worth our time to do these free videos on a daily basis or not. So if you guys could do me the favor, just get in that habit, get over there, click like, click retweet, and everybody's happy. In addition to Twitter, we're also on Facebook. So you can see that on the screen in front of you. You should see a web address. And there's over 900 of you that have signed up to become part of our Facebook group, which is just wonderful. We appreciate engaging with you in that format as well. All right, let's go ahead and dive into some market analysis now. You can see that I have the S&P 500 pulled up in front of us, and 47 points to the upside. That's a big day, ladies and gentlemen. That was a 1.74% move. You can see how aggressive that candle was, not only in the size of the candle, that's a very big range for that candle, but notice that we also closed at the exact top of the day. You can't get any more bullish than that going into the weekend. Now, of course, that doesn't guarantee anything, but generally speaking, the main philosophy behind that is, had the market been open another hour, another 2 hours, another 3 hours, the path of least resistance was to the upside. People couldn't wait to buy more at higher prices. And so that does bode well for Monday. But of course, there's 2 days, on a weekend where anything can happen news-wise that could derail that. But right now, technical analysis speaking, very positive sign there. You'll also notice that it helped kind of resolve another issue from a technical analysis perspective, which is we have the highest closing price on the S&P 500 going all the way back here to Groundhog's Day. You guys will recall that it was Groundhog's Day that really kicked off that nasty drop to the downside. So as you can see, the closing price today was even higher than some of these closing prices that we had 2 or 3 weeks ago. So that's a good sign as well. We're not to all-time highs yet on the S&P 500. I mentioned we are in the Nasdaq, but the S&P 500's got a little bit of work to do. But these are all very positive developments here. And of course, we remain with a bullish posture using that market forecast green line, as I mentioned last night. All right, let's take a look at our next chart setup. And you can see here that we've got green across the board. That's also a very bullish sign. I talked about yesterday, and I've been talking about it a lot in the videos recently, that Nasdaq has really been the most impressive. And we talked about how Nasdaq's moving average was green. That line right there is green. And I did get a comment in the YouTube comments. Somebody asked me, is it hard to set up that moving average with the different colors? Yeah, I'm using what's known as ThinkScript computer programming code in order to do that. So it's not something that comes as a pre-built study set or anything like that. But the good news is once you guys become subscribers to Market Scholars, for those of you that plan on doing that, my plan is to recreate a tutorial video similar to what I had with my previous employer to make sure that our clients can get their screen set up similar to mine. So be on the lookout for that for those of you that sign up for our services. But back on track, the Nasdaq was already giving us leadership signs before breaking out to all-time highs today. So that's how technical analysis works. You're not always going to catch the bottom, but as long as you're looking at these charts every single day, you're going to notice the slight differences between one stock versus another or one index versus another, and you can start planning your trades accordingly. That's part of the reason we focused on that technology stock in last night's trade application example. All right, let's go ahead and take a look at our next chart here. This is going to be our 3 green arrows chart. And the background color here is going to mean slightly different than what it meant on my last chart set up there just a moment ago. Here, when you see the background color charts green, like all 4 of them are here, it means that we've got 3 green arrows across the board. So that's a welcome sign as well. We've seen resilience out of the market this week, and we closed at all-time highs. In fact, I think we closed at all-time highs on the Nasdaq, but we were really close on the Russell too. Very close. Didn't quite get there, but we could see if Monday is a big day, we might be at new all-time highs on the Russell as well. When you look at the candles, take a look at this, guys. Every one of these 4 indexes is closing at a daily high. Not only that, but a weekly high too. But that's pretty nice, right? Again, it just kind of gives you that impression that had the market continued to stay open, we'd still be buying and buying and buying, and prices would be going higher and higher and higher. So, the bulls are back. They're in control of this market, no matter how you slice it. 3 green arrows across the board. And so for those of you that are trend traders, it kind of gives you the green light to start hunting for those trend trades once again. All right, let's now take a look at our longer term charts here. These are our 1040 crossover method charts. Now, this is a 3-year chart that you're looking at right here. Every one of the candles is 1 week in length, and what we're looking for are crossovers of the moving averages. As I mentioned last night, this is not something that changes on a daily basis, and so we don't spend a lot of time analyzing these charts. Just a recognition that we continue to be in long-term bullish trends right now. I mentioned in the intro, today was the 9-year anniversary of the market bottom, and it reminds us that we're currently in the 2nd longest bull market in history. And so, I don't think a lot of newer investors and traders feel that way, but it's true. We are in a spectacular era for stocks right now, and I hope a lot of you have been mostly invested for the last couple of years to enjoy some of these rides here. And of course, if you haven't been, if you've been a little bit hesitant because you haven't felt like you've been confident enough to place trades, then that's where David and I are going to help you in the future as we launch Market Scholars. Of course, we're going to have a full slate of classes where our entire goal is to apply what we're teaching you by building out portfolios, and we're looking forward to doing that. All right, let's take a look at our next chart now. And this is our 12 grids here for the S&P 500. So I'll kill the camera feed here so that way we can see all 12 of these charts. And similar to last night, we got a clean sweep here. We have green across the board in the United States of America. That's a good sign. And again, we're back to the market forecast indicator when we're interpreting these charts, meaning that when you see green on these charts, it means that the intermediate term posture on the market forecast is telling us that it's bullish right now. So we talked about technology last night, and you will notice that technology was one of the biggest performing sectors today. When we looked at it here, we were impressed because the moving average line had already turned green for us. After today, there's no question, right? We blasted right through that double top right there. So technology, red hot. And if I had to kind of, put a theme on the entire market in the last several years, the one consistent sector has been technology. For those of you that used to attend my sector-based trend trading class at my old employer every Friday afternoon, you know that technology was by far and away our biggest exposure from a sector perspective. In fact, I probably can pull that up just to highlight that here real quick. Give me a second. Where are we at? There we are. So there's our current positions for the Friday class. And boy, I just noticed this too. Clean sweep across the board in our Friday class today. And remember, I'm going to be getting this going again very, very soon. The class will likely move to Monday, just to give you guys a heads up. But I still got this portfolio rolling here. So we're going to pick up where we left off from that perspective. And we had a clean sweep today. Over 30 of our positions, all to the upside from what I can tell right here. But the point I wanted to make is, you know, if you look at our positions, all of these positions we have, by far and away, our biggest sector exposure is technology. We've got Cisco, we've got Adobe, we got MasterCard, we got Microsoft, we've got Texas Instruments, Microchip, Visa, Corning, eBay, and APH. I always forget the name of that one. It's a smaller company. Let me check it real quick. APH. Let's see here. Amphenol. That's right, Amphenol. So anyway, we are, you know, loaded stuff to the gills from a technology perspective. But remember, I haven't been buying any stocks for that class. I've been managing the stocks that we have, but I haven't been buying stocks from that class since this past fall. So we haven't even been adding technology in recent months. But the point I'm trying to make right now is that those are stocks that we've owned for a number of years in some cases. And so technology has just been a really consistent, robust trend throughout this bull market. And here we are showing itself, reasserting itself to the upside, showing its bullish tendency. So we love to see that because remember, technology is generally viewed as a very bullish sector. Usually you feel better about the overall market prospects if technology is leading the way as opposed to something like the utilities, as just one example. But again, across the board, clean sweep today from a sector perspective, not only in the bullish postures, but just simply from a price perspective. If I come over here briefly and look at the Market Watch tab, let me go to sectors. And, oh, I take that back. Telecom did slip just barely, 0.1%. Now, telecom, you have to remember, is a little bit, I put an asterisk next to telecom because technically there's only 3 telecom stocks in the entire S&P 500. You'll notice that what I'm using as a proxy to represent telecom on this particular setup is IYZ, which is way different than all of these other ones here that start with an X because it's in a different fund family. All these other ones make up all the stocks that are in the S&P 500. But because telecom currently only has 3 whole stocks in its entire sector in the S&P 500, Select Sector Spiders doesn't have a separate one just for them to kind of implement that philosophy. So I have to use IYZ, which does include small and mid-cap telecom companies as well. So that one is a little bit of an asterisk there. Main point is we had a very bullish day across the board. Consumer discretionary, healthcare, utilities, real estate, I mean, you name it, we were bullish today. Let's get back on track with another one of these. Oh, by the way, before we leave the sectors here, I do want to show you down below here, real estate. In fact, let me right click on real estate. That's XLRE, and I'm going to go to maximize sell so that way we can see it in greater detail here. Again, we have a green background chart, and we have really, we started turning up right here. Right here. That's where that green line stopped going down and started going up. So it was really on this candle back here where we started to get that bullish posture, and we've had 4 straight days of upside ever since then. Now, the reason that I'm starting to become a little bit more optimistic now, I'm speaking strictly from a technical analysis perspective here, so I got to be careful because some of you heard me talk about REITs earlier in the week, and you know I still am a little bit skeptical from a long-term value perspective where they stand because I don't think they're at their historical high yields in most cases. So from an income perspective, I'm not as enthusiastic about the REITs, but as a short-term bottoming reversion to the mean type of a trade, not an investment, I think it looks kind of interesting. You'll notice here that we closed at the high of the week on today's candle with the XLRE, and that did breach these prior highs as well. So that does take us all the way back here to this candle on February 5th. So that's good. We're starting to really establish a bottom. Remember, for the REITs, that's even a bigger deal than if I would have said that for, let's say, technology or industrials or what have you, because the REITs have been lagging for so long. I mean, it's been months of downside price action. So finally, we're starting to see some legitimate price action back to the upside where it gives you the impression that it's trying to bottom, or at least testing the waters of bottoming at this point. So that was a good sign. You can see we're now trading above that moving average itself. Moving average is yellow in this case, so that means that the moving average is going down and price is above that moving average. So it's a little bit of a cautionary yield sign right there. You will notice that the last time we had that yellow show up, it was just for a day, and then that thing turned right around again. So that yield sign was worth considering back then if you had wanted to get bullish at that time. So we got to be careful here as well. Remember, downside price action can take a long time to wear out. Sometimes bottoming process takes months, and it just aggravates people that are waiting for a quick reversal. So we got to be respectful towards that as well. But right now, it is a very good sign. We now have 5 straight up days for the REITs, and our trade application example is going to come from that area here after just a little bit. Before we do that, let's go ahead and take a look at our next 12 grid here. And that's going to be our foreign markets 12 grid. Hey, things are looking a little bit better here as well. Yesterday, I think we had, what was it, four of these charts that were pink. And so now the only odd man out is India, which is kind of interesting. India had actually been a leadership country from a stock market perspective for much of late last year. And so I don't know if it just got a little bit ahead of itself or what, but right now it's finding itself in kind of a lagging position. But across the board, we do have bullishness with the rest of the countries. Now, obviously, the charts still have a little bit of work to do. If you look at something like, let's just take United Kingdom as an example down here, there are a couple things that you appreciate about it. Let me maximize my sell here. One thing that I would appreciate about this is that we do have a double bottom in place here on EWU for the United Kingdom. So we have kind of a clear line in the sand, so to speak, of if you were to get bullish on this particular trade, then you know where your kind of rip the cord signal is. But on the flip side, I would still be a little bit nervous here about this falling 30-day moving average, which is still colored red. So until we can breach that to the upside, I want to be a little bit more cautious about how I'd approach a chart like this. Yes, you do have a bullish posture right now because that green line is now trending up, but because price is still below a falling moving average, probably not the type of trade you want to get overly aggressive with at the same time. And a lot of the foreign charts do look like that. If you had to look at one of these charts as being kind of the strongest from both a trend and a current posture perspective, it's probably maybe a 3-way tie between Brazil up here in the upper left corner, its neighbor to the right, Russia, right here, and then way down here in the lower right corner, South Africa. Those are probably the 3 most robust charts that we see from a foreign perspective right now, at least of this group of 12. All right, let's take a look now at our last 12 grid. This is our Intermarket Analysis 12 grid. And here we do have more of a mixed bag, which is by design. Remember, these are not all stock-oriented charts that we're looking at here. The one that I've been keeping my eye on, as I've been mentioning in this video here recently, is DBA. I think that one looks interesting. It still has a bullish posture. Yes, it was down today, but its uptrend has not been, it has not been jeopardized yet, even with this pullback that we've seen this week. In fact, some of you might recognize that as potentially. It's a big capital P there on potentially, but potentially setting up for a bull flag. We'll keep our eye on it. What we do know factually is that moving average is up, price is above that rising moving average, and this has been a very consistent chart. It hasn't had a lot of violent movement up or down. And you can see what happened from a VIX perspective today, down 11%. Of course, that's a big move there. But anytime we have the markets breaking out to the upside, like we saw the Nasdaq hitting all-time highs today, we should anticipate that the VIX will struggle on a day like that. So, boy, oh boy, how far we've come in just a month's time. I mean, it's kind of remarkable to think about. It was right back here when people thought the sky was falling, and this was literally 1 month ago, right? This is February 5th right here, and then this was February 6th. And here we are on March 9th, and it seems like all is well in the world again. So anyway, interesting times here in the market. But the main takeaway, of course, is that we are very bullish, again, here in the United States. And a lot of that is on, some of this news regarding, tax reform, tariffs, jobs, you name it. People want to hate on this market rally right now, but the truth is, fighting the tape is generally not a responsible way to monitor your portfolio. So if you've loaded the boat with a whole bunch of bearish trades, you really have to consider the consequences that might come with that as well. All right, let's now talk about our trade application example for the day. So let me go back over to another, just a one grid here with the market forecast pulled up. And I'm going to pull up a ticker symbol CCI. Now, some of you will recognize that ticker symbol CCI, and I'm not referring to the technical indicator. There's a technical indicator called the CCI as well. This is actually a stock, or I should reiterate that it's actually a REIT. Crown Castle International is now a REIT. Yes, you heard that right. They are like American Tower in that they have real estate in the sky, so to speak. You know, they run cell phone towers. And, you know, the IRS a few years back allowed those types of companies to restructure as REITs, and they've actually been outperforming REITs. They've done a very good job. They're not your traditional types of REITs, but they've actually done better than, let's say, healthcare REITs or apartment REITs or what have you on the whole. As we look at this chart, you can see it's not really going anywhere. But remember context in this situation. If we were to compare it to just XLRE all by itself, which it belongs to, this is one of the dozens of companies within the XLRE. Remember, XLRE is in a series of lower highs and lower lows, potentially breaking that right now, just starting. But CCI, you can see, is more of a sideways chart over the last 3 months. It's not downtrending. It's really just in a sideways channel. The reason I think it's kind of interesting is because we have this triple bottom, a very clear defined set of support areas down here at about 104. So we bounced from that level here in mid-January. We bounced from that level again right here in mid-February. And here we are at the beginning of March at that same level. It never really wanted to breach that level. So that's the good sign. We have a defined level of support. The bad sign is we don't really have a trend to the upside either. So we could very well find ourselves, you know, in an area of resistance reasonably quick. So I'm not really excited about doing something like we did last night, which is buying long calls, because I'm just not sure it's to that point where it wants to truly break out. We might still be stuck in this sideways range for a while. If this were a highly liquid ETF, I might think about doing on this one what I did on Tuesday's video, which was an iron condor on GLD. But in this particular case, Crown Castle is not nearly as liquid as GLD. I talked about the importance of liquidity when we have a multi-legged strategy like an iron condor where there's 4 different strikes involved. It's paramount. We're not going to do that here because this is just not that popular of a company. But does that mean that we have to completely forget about trading options on it? Not necessarily. You know, the less liquid names can still be tradable from an options perspective if you are dealing with fewer strikes. So one of the fewer strike kind of strategies that you might consider implementing out there is called selling a put. Now, I do want to be careful on this one as well. Some of you have requirements as far as liquidity goes and, you know, whether there's a tight enough spread between the bid and the ask. You know, what we're going to focus on in this trade is out here in the April contracts with 42 days left, we're going to focus on that 105 strike right there. Now, notice that its bid is 120, its ask is 140. Some of you guys might have a rule that says, hey, if it's more than 10 cents between the bid and the ask, I'm not going to take the trade. So by all means, follow whatever rules you have. But you will notice that this is the strike that has the most open interest in there. So we're certainly not the only folks that are kind of attracted to this particular strike. There's 1,300 contracts in the open interest for the 105 puts here. So some of you that are newer to options might be wondering, okay, so what is it that you're doing exactly? Well, I'm selling a put is what I'm doing. And selling a put is kind of like you becoming the insurance company. You're going to take in a credit to assume somebody else's risk. Remember, when you're long a put or you buy a put, it gives you the right to sell a stock at a certain price. So remember, when we go out and sell a contract, sell a put in this case, there's somebody on the other side of the coin buying that exact same contract. So somebody thinks potentially the exact opposite the way that you think when you're placing a trade. We have to be respectful towards that. When we look at this 105, what that means is somebody might already own 100 shares of Crown Castle, but they're nervous the stock is going to go down. So they're going to buy their insurance policy at 105. And that way, if the stock were to fall to, let's say, $80 per share, they can then turn around and sell it for 105. Well, they have to pay money just like you have to pay money to your insurance company. But we as the put sellers, we become the insurance company. We're going to assume that risk. Now, we have to assume the consequences that come with taking that trade as well, because if it does go down to 80, we made the wrong decision, right? So we have to be careful with that line of thought. But what it allows us to do is take in premium to begin with, which is a way that we can make money off of time decay. Remember, if this stock were to just go sideways, since it's at $111 right now, if it just goes sideways for the next 42 days, then this premium that we're going to take in here, which is probably going to be about $1.30, so 130 bucks, we're going to take in and we're just going to hold on to it. They're going to give us that in cash in our account up front. Our goal is to hang on to that as long as we can. If this stock is trading above 105 on expiration day in 42 days, then we keep all $130 of that. If it's trading way above 105, great. If it's trading just sideways from where it's at right now at 111, fine. Even if it falls, let's say $4. If this stock falls $4, even though we're somewhat bullish on it right now, we would still make money on this trade. What we don't want to have happen is for this stock to fall below our break-even price. And if we ever wanted to figure out what our break-even price is, let me get my calculator out here. And I'm just going to take the strike price of 105 minus whatever credit we're anticipating receiving. Now remember, I'm doing this on a Friday afternoon. We have no idea what this thing is going to execute at on a Monday morning. But, you know, let's just say it's going to get filled at the midpoint of where it closed today, $1.30. So $1.30 is right there. So our break even on this trade is really 103.7. So if you assume that CCI is going to fall from 111 right now to below 103.7 in the next 42 days, you would not want to take this trade. If we want to look at where that break even is on the chart, I think it kind of helps us see, you know, what I'm driving to with our triple bottom that we have here as well. In fact, let me do this. I'll make a drawing on the chart here, and so that way we can kind of see it all together. So let me just do this. I'm going to kind of draw it somewhere in that neighborhood. And then I'm going to right click on the drawn item. I'm going to go to edit properties. And then I'm going to type in the beginning point, 103.7. Kind of sounds like a radio station, doesn't it? And another one, 103.7 on the end point. And that way it'll make it a nice straight line for me. If I want to change it a different color, let's do purple here. Let's go OK. And you can see that that's where our break even point is on this trade. Again, that still doesn't guarantee anything, right? Markets will do whatever they need to do in the end. But if you want to help yourself feel more confident in how you're approaching your trades, then looking at certain things like this from a technical analysis perspective can actually get you out there and trading. Remember, you got to be in it to win it. You know, you can only take things from a theoretical perspective so long before you wonder if you're going to constantly be on the outside looking in. So anyway, if you believe that this stock stays above that purple line for the next 42 days going out to this expiration date over here, then that could very well be an interesting trade to take. One other thing I'll quickly point out, there is a $1.05 dividend coming in here relatively quick. And as a put seller, you are not entitled to that dividend. If you are eventually put that stock, remember, if this stock falls below 105 and you forget to close down your trade in April, you would then be forced to buy 100 shares of it. At that point, when you're the shareholder of the company, then you're entitled to the dividend. But if you're just selling the put, you are not entitled to that dividend. In fact, that will be a slight disadvantage because on the day of that dividend X date, $1.05 will come out of the price per share as well. So you've got to keep that into consideration as well. But with that, let's go back over here to our trade tab, and I'm going to place that trade. And I'm going to put this in as just a day order. Now that it's Friday afternoon and the market's closed, this will go in as of the day of Monday. So don't worry about it expiring over the weekend or anything like that. And I am going to try to get that filled at $1.30, right at that midpoint that I discussed before. So confirm and send, and everything looks good. Off we go. All right, well, thank you so much for joining me yet again here on the Market Outlook video. It's a pleasure to be able to work with you. I will be with you on Tuesday next week. David will be with you the rest of the week. Have a great weekend. Enjoy yourselves. Get out, get some fresh air. Spring's on the way. And hope you've been enjoying our different classes that we've had this week as well. And we look forward to working with many of you going forward. Best of luck with your trades and your investments. Goodbye for now.